Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Ryan McCormack, factor and core equity strategist at Invesco, for a review of weekly performance in the Qs. We'll also take a look at some big cap earnings that we saw over the past week. Ryan, it's great to see you as always. Welcome back to Trade Talks. And as we can see over the past week, a little bit of a dial back in performance here after what's been a really great start for 2023.
Yeah, so I think in looking from last Tuesday to today, we have QQQ and QQQM up 1.03 and 1.02% respectively. Outperformed the S&P 500 up 23 basis points, and S&P 500 value up 0.11%. Saw that continuation of earnings season and sort of this resurgence of revenue and earnings growth from some of the major players within the Nasdaq 100. Then we also saw some optimism around the prospects for a soft landing. So, last Wednesday we got the anticipated and 100% priced in July rate hike from the FOMC, which put the target rate at 5.25% to 5.5%, the highest level in 22 years. Comments from Powell continued to sort of maintain this data-driven commentary, really like talking about how there's the potential for them to hike in September, along with the potential for them to hold steady and monitor the data. I think as we look at the markets, they're more in favor of the FOMC holding pat with less than a 20% chance of a rate hike in September, according to Fed funds futures. And then Thursday, we saw a better than expected Q2 GDP print at 2.4% annualized. That's better than estimates of 1.8%, and up from Q1's final 2.0% reading. And then right after on Friday, the PCE deflator, of course, the Fed's preferred inflation gauge, came in right around at expectations on both a month-over-month and year-over-year basis. The year-over-year reading showed further signs of slowing price growth. So, I think from the market's perspective, we're still inching towards that 2% Fed target, but with each sort of reading in various price gauges, we seem to be heading in the right direction. So I think you're sort of seeing this optimism for potential soft landing, and then buoyed by some of these earnings reports.
All right, let's take a look at sector performance here. Of course, heavily weighted towards the tech if you want to think about what outperformed relative to the rest of the sectors.
Yeah, without a doubt. I mean, communication services was the biggest contributor to both absolute performance as well as relative return against SPY, which is the S&P 500 proxy. We actually saw 7 GIC sectors contribute positively to relative outperformance, and only 3 detractors. So we saw energy, consumer staples, and industrials showing underperformance against their counterparts in SPY.
And finally, you had mentioned revenue growth before, and you're starting to see an uptick again. We know we had the big names like Alphabet and Meta report just recently. Any trends that you noticed with those two?
Yeah, well, I mean, for starters, right, you look at the earnings report and just from a stock perspective, right, Meta and Alphabet were the 2 largest contributors to absolute performance over the week for QQQ, and the 2 largest contributors to relative outperformance against SPY. Meta for the week up 9.59%, Alphabet C up 7.41%, and Alphabet A up 7.64%. But this 2023 kind of continued year-over-year revenue growth acceleration is starting to take hold. And this is after, Meta showed 3 quarters of negative revenue growth. That was Q4 through Q2 of 2022. Alphabet's revenue growth slowed to near flat in Q4 2022, but ultimately you can kind of see that it's coinciding with the turnaround performance with these stocks after the challenging 2022 that they faced, and we saw that growth start to wean. Obviously, we're seeing a reacceleration here. Beyond that, you look into the individual reports. Alphabet seeing sort of the continued ad revenue turnaround, 3% growth year over year, and CEO Sundar Pichai, continue to reference the demand that the company is seeing in their cloud platform and touting their AI capabilities and tools. From the Meta perspective, better than expected earnings and revenue, Q3 revenue guidance that surpassed analyst expectations, and Mark Zuckerberg's year of efficiency continues. Right, we see the company cutting costs, and noted that even though expenses in the quarter did rise year over year, capital expenditures for the year likely going to be lower than initially forecast. We also saw that ad revenue kind of rebound in Meta, much like we saw with Alphabet, 12% year-over-year growth, and of course, Zuckerberg talking about the AI initiatives, which certainly seems to be a hot topic over the past 3 months, and without a doubt in this round of earnings reports. But we're going to continue to watch the earnings picture. We have sort of the next tranche, Apple and Amazon reporting tomorrow, and then we have Nvidia later in the month in about 3 weeks.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.